world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here.
Hello and welcome to Rebank. I'm your host, Will Beeson. Today we're joined by David Green. David is the Chief Product Officer at Earnest, a digital student lender and refinancing provider. The student debt market in the U.S. is unique in the world. College is exceedingly expensive, and students fund their education by borrowing from the government and private lenders. Despite the size of the market and its decades-long history, student lending doesn't necessarily operate with the same sophistication you would find in other credit markets. On top of all this, the impact of total outstanding student loan balances on the U.S. economy is significant. David and I talk through some of these points and explore some of the more innovative approaches being taken to address student debt levels and align the interests of students and schools. In addition to the insights we deliver through our podcast and newsletter, Rebank offers advisory services to fintechs, banks, and corporates. Drawing on our experience starting, running, and advising fintech businesses, and our vast network of the most impactful fintech entrepreneurs, investors, and innovators around the world, we help companies make sense of fintech, work through specific questions, and optimize proposition and strategy. For more information about our services, please visit bankingthefuture.com. Thank you very much for joining us today. Please welcome David Green. David Green, welcome to Rebank.
Thank you. It's great to be here.
I think we can have an interesting conversation today about education finance in general in the U.S. and probably touch on some of the more innovative approaches that some are starting to consider, income share arrangements, so-called ISAs. So maybe to set the scene, walk us back to the pre-Earnest days. You know, how did and I guess does most student financing work, and what was kind of the immediate opportunity to step in and improve?
There's two types of loans. Earnest today has mostly been in the refinance space. So what happens in student loan financing is the federal government is the first option for most people. And if you are an undergrad, they will fund you up to a certain amount. And if you are going to grad school, they will fund up to your entire amount. The federal government, in doing so, does not do any type of risk-based underwriting. They give the same rate to everybody. Which is what at the moment? A grad rate is, I think, around 7% right now. And what that means is that people who have great credit going into school, and people who have poor credit, and people who would get a job and be making a steady salary, and people who had trouble finding a job, all of those people were paying the same rate. And there's reasons that they want to do that to make it fair for everybody, but it's not how lending works in really any other place, right? There's underwriting, and it's based on your ability to pay and your credit history and your willingness to pay. So there was this opportunity to look at people who had graduated, already gotten their degrees, and say, oh, this person graduated. We now know a lot more about them. We know that we know their salary. We know where they work. We know they probably have built up some credit history over the last 4 years. So, and we're able to offer them a better interest rate than they were getting. Student loan refinancing is a great product from a fintech perspective. It's one of a handful of financial products that is just all good for the borrower. So, you can save literally tens of thousands of dollars. Many times you can both shorten the repayment time and get a lower interest rate. I think that's a great opportunity for people to really set up their financial life and help them get out of debt faster.
So this is obviously an insanely big market that you guys are operating in. But at the same time, if you look at the likes of SoFi, who I think was maybe the first mover in the space, they've over time diversified into other products and not just loan products, but banking type products. How do you think about the merits of going deep on this one space versus diversifying and offering more comprehensive banking type products to customers?
I think that's something that in the early days of Earnest, there was this idea of kind of disrupting banking. And I think that's kind of what SoFi is trying to do. But that's not really getting at solving this one problem very well, which is focusing on access to capital, focusing on student loans, and how do we make that the best experience? And it's just a huge problem that's not solved, right? So there's still a ton of room there, and we think that's where a lot of our expertise is.
So if we step back a little bit and just think about the broader student lending market in the U.S., I'd be interested in your thoughts as something of an insider, like what works, what doesn't, and is there indeed, as it would seem, there is a massive structural problem that should be addressed?
Without question, there's a problem. You hear about it every day. This is affecting people buying houses. Like this is an increasing problem. There's no signs of it slowing. College tuition costs are skyrocketing, right? Like outpacing inflation by a lot. And there is a question of, if you want to help fix that problem, like where is your entry point? Are you going to lobby Congress? The federal system has its own issues, right? They give everybody unlimited debt, and they don't really regulate schools maybe as strictly as they might want to. And then there's the colleges, and they're just raising tuition because they can. The number of people attending schools is going up every year, and so they just keep pushing up tuition. Or is it the lenders, which are enabling, if the government says I'm only going to lend up to this, then the private lenders come in and fill that gap. And so it's hard to know where to get in. I think as a lender, we think there's a ton of room for improvement in that space. Some of the things we know are problems are people, when they get out of school, they don't know what they signed up for. They don't understand the loans. They don't know that, they took out a $10,000 loan, but by the time they pay it back, it'll be a $15,000 loan. And they don't know that, if they pay $25 a month, like while they're in school on their loan, their total cost of the loan is going to drastically decline because you're paying off some of your interest as you go. Those are some of the problems we thought about. There are other places where you could jump in and solve, which is like, do you want to tell people that this school doesn't perform as well, or do you want to tell people that this degree doesn't perform as well? And we thought, at the point where somebody is coming to look for a loan, they've kind of made up their mind where they want to go. And so we want to help them make a really informed decision. We want to help them know what they're signing up for. We want to help them make the best choice of repayment. We want it to be low stress. We want to make it easy for them to collaborate with their co-signer and be able to get to school.
I mean, I think one of the most damaging things about the cost of private higher education is that, so we still call it education, but you're really trying to buy an income premium later in life, right? And so it is. You talked about this school doesn't perform as well, or this degree doesn't perform as well, because if you are viewing it as I'm going to pay $50K a year or $200K over 4 years, how quickly am I going to amortize that investment versus I'm interested in continuing my growth and education and development, which is kind of a sad situation to be in, and maybe it's why people are. Well, I guess there are two relevant pieces that come out of that. One is the kind of boot camp type offerings, and they tend to be around kind of technical skills, and those almost kind of play on that. If I'm going to be spending money and I'm going to be acquiring skills, which are going to lead to income results, then I can do it in a much more efficient way than studying English and history and philosophy, because that's irrelevant. All I need to know is to code. And then on the other hand, people are exploring concepts like ISAs, these income sharing arrangements. I'd be interested in your thoughts, maybe first on kind of the boot camp model as a potential alternative to traditional university.
Yeah, I think the boot camp model is really interesting because, to your point, I think there is a subsection of people who are using college specifically as that kind of transactional. I'm going to college because I want to increase my future earning potential, and if I could do that in a different way, I would do that. Or a less expensive way. There's also a lot of time, right? And so I think the boot camps can definitely help there. And I think some of the big tech companies now are not, have just moved to stop requiring college degrees at all, which starts to make that even more interesting. Then you start to put pressure on, the schools to be more competitive with their costs, et cetera. So
I think it's tough to argue from, broader social standpoint that training people with one specific technical skill versus a broader set of kind of cross-functional critical thinking skills is somehow better. And maybe that brings us on to the point of the ISAs. What are your, do you want to maybe describe for the audience what those are and then maybe share your thoughts?
Sure. ISA is an income sharing agreement. And so basically the concept here is the school or the boot camp would take share in some of the risk. So if you are wanting to attend a coding academy, you would go for free. And then if you never got a job, you would never pay any money back. And if you did get a job, you would pay a certain percentage of your income usually it's for a set amount of time, up to a certain dollar amount. And, the great thing about that is it really aligns incentives. The college completion rate is like the biggest predictor of somebody defaulting or not defaulting on their student loans. This kind of gives you the try it and if it works model, which is definitely better for students and goes back to incentivizing the schools not to just graduate somebody, but to make sure they're equipped to do a real life job.
And so that's, I guess, Lambda School, the venture-backed, I don't know if it's technically a boot camp, but it's kind of that technical skills focused piece with the income share arrangement built in.
Yep.
And then I think Purdue has been pretty progressive in exploring ISAs for its normal matriculants. I don't know what the criteria are to qualify for that program. It's going to be fascinating for sure to see whether other schools kind of follow suit. It's tough to see how they wouldn't.
Yeah, and I think one thing that would be interesting is schools today don't price their degrees according to the expected future value of the income stream, right? And they don't have any incentive to do that. They can price everybody the same. And if they started to do this and start using the income sharing agreement, that's one of the things that you might start to see, which is we know that a teacher degree is very stable, but the salaries are lower. So we won't charge as much for that degree because we know we're not going to get as much money back on the backside versus we know if you're getting your MBA from X place, that degree can be much more expensive. There's always this subsidy going on from people who are, in this instance, it's going the wrong way, from people who are making much less, subsidizing the people who are making more.
As kind of developed societies look around and think about what types of jobs they're often struggling to place, it's often teaching and nursing and some of the most important informative roles.
Yep.
For I think precisely the reason that you're talking about. It's so expensive to get educated in those areas.
For sure.
And pay isn't as high. What other areas within kind of the broader education space, education finance specifically, do you see opportunities for progress and innovation?
There's still this whole piece on school selection, and it's something where it's not quite as individualized as if you get this degree from this school, et cetera. But these schools have better outcomes, and trying to help steer somebody in that school selection process. So that's not something that I'm not sure there's anybody who's really in that space or any natural party who's equipped to do that today. If you look at the lenders, it's something we definitely consider and something we continue to look at. We do it in various ways, but by that point, somebody wants to know if they can go to the school that they've selected. And for the whole year before, they're touring schools and they are thinking about like, oh, where do I go? And many times, like, the cost is not coming in, or like the return on investment is not coming into that equation. And so there's definitely a lot to be done there. I think the question is who's going to own that? And then there's still, room for improvement on the servicing piece. That's a challenging area as well, and one where there hasn't been a ton of innovation on how do we help people pay back faster? How do we make sure people are not entering into programs that end up hurting them in the long run? So I think there's room for that, and that's something that we as our own servicer do have the opportunity to tackle and are definitely thinking through.
And I think you're about to launch a kind of direct originated loan offering, right?
Yeah, so we are shortly here going to come out with our in-school offering. So this is for people going into college or into grad school. And when you enter this market, you kind of have to think about where do you think you can affect change or have a positive impact, because at the same time that college tuition costs are going up, the difference in starting salary between somebody with a college degree and a high school degree that spread continues to get larger. And so like it's also more and more important to have a college degree. So, we think there are some very real opportunities for us to create a loan that is more transparent, built for people who are going to school today, and help people make the right choices now so that they won't find themselves in these problems later on.
So where does Earnest go from here?
We're in year one of many years of originating student loans. So, our focus this year is just getting the product out there, making sure we're accomplishing our goals as far as transparency and flexibility, and having it be a really updated experience for students and for co-signers. And I think next year, as we look at ways to move either earlier in the process or later in the process, there are still challenges like, one of the things we didn't talk about is another reason why people take private student loans is they forget to fill out this FAFSA, this financial aid form that you were required to fill out to get loans from the federal government. And it's extremely complicated and extremely arduous to fill out. Again, not in a form that you would expect to see today. And I think when we talk to financial aid officers at various high schools even or colleges, just the number of people who are not filling that out because they don't know about it, or it's too complicated, or it's who knows what reason, is like huge. And so those people aren't getting the best information. They might not be getting the scholarships they need. So I think that's an area that we're definitely thinking about that needs improvement.
That scholarship piece that you mentioned there at the end is also relevant, because so much of that stuff is you may qualify for the scholarship, but you may not know about it, and you may not be familiar with the application process, or you may miss the deadline, and it's that across schools it's so different opportunities, but something that's still done on kind of like a one-off basis. It'd be interesting to see someone kind of address that challenge.
Yeah, and I think there are different players that are trying to take that on. But as you said, like it is a very big landscape, and it's hard to get all the data in one place. Data collection's getting easier. You can scrape websites now fairly easily. So I think the opportunity is there to take a big step forward and not only build the right product, but be able to deliver it to people, because that's maybe the more challenging piece.
Excellent. David Green, thank you very much for joining us today.
Yeah, thanks for having me.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.